Hello everyone, Eric here with the Stock Market Companion video update. Today we're going to talk about the stock that everyone asks us about, the most exciting stock that there is. That's Apple Corporation. We're going to answer these three questions about Apple. Number one, at $353 a share, is the stock price too expensive? Two, what would be a strategy for buying the stock? And three, what about Steve Jobs' health? We're going to do the things that every successful investor must do when considering a stock like Apple. One, we're going to look at the fundamentals of the company. In this case, earnings and revenue growth. Two, we're going to look at the individual stock chart of Apple. And three, we're going to look at the broader market. What is the condition of the broader market? Because we know that even great stocks like Apple will respond in kind to how the broader market is responding. Let's take a look. Here we have a picture of Apple's earnings and revenue for 2010, broken down by quarter. In the first quarter, Apple earned $3.33 a share. That was up from $1.33 a share the year before. That's tremendous growth. In the fourth quarter, Apple earned $6.43 a share. That's almost double their first quarter's earnings, and it's almost double the earnings from a year before. That's very strong earnings. Obviously, from the earnings standpoint, very strong. We see on the revenue side, we see the first quarter revenue of $13.5 billion, and at the last quarter, this last quarter, Apple reported $26.7 billion of revenue. That's essentially a doubling in quarterly revenue in 1 year. That's a huge growth. We see from a year before, we see a 70% growth on that quarter alone. So from a revenue perspective also, extremely strong. But how do we equate that to the share price? The share price being today $353 a share. Well, that's easy. Let me show you. We'll use these earnings of $3.33 ranging to $6.43 and just using an estimate, let's just say Apple is able to earn going forward approximately $5 a share per quarter. $5 a share per quarter times 4 quarters takes us up to $20 a share for the year. $353 per share divided by 20 gives us a price-earnings ratio of 17.6. A 17.6 price-earnings ratio is basically a market average. The market average price-earnings ratio is approximately, right now, 17. Therefore, we know that Apple is trading at about the average price for the market. But we see that Apple has tremendous growth, 70% year-over-year revenue growth, for example. Under normal market conditions, we would expect to have to pay a premium for that growth. With Apple selling at $353 a share, we're not having to have to pay a premium at this time. So from a earnings and revenue growth standpoint, and the share price at $353 a share, if Apple's able to maintain the $5 a share approximate earnings per quarter, Apple is a good value at this time. Now we've identified that the $353 a share stock price for Apple is a market average price when comparing it with price-earnings ratio. Now let's look at the stock chart and see whether we can get into Apple at a good strategy. What would be a strategy for buying Apple based on the stock chart? Here we see the Apple stock moving from March of 2009 at around $80 a share to today on February 10th, 2011 at approximately $353 a share. And we have this very strong growth in share price. And we had, here you see this long candle. This was the flash crash. And here we have, back on March 5th of 2010, we have what at the Stock Market Companion we call the buy point for Apple. This was when Apple decisively moved up above $200 a share. And besides the flash crash and this turbulence in here, really hasn't looked back. Now we're at approximately $353 a share, and we're now having to ask ourselves, is this now a good time to get into the stock? When we look closely, we have Apple reporting earnings during this time, and we had a lot of turbulence. We had turbulence because Steve Jobs during that time was announcing his leave of absence due to his health situation. But we have now the stock moving back above that area of turbulence, and we have the stock pressing on until today. At the Stock Market Companion, we like nice and tight stock charts, representing stocks that are predictable and where we can put in a good safe stop. Here with Apple, we see a fair amount of turbulence that makes us a little bit uncomfortable. Additionally, the background market is a little bit extended, which we'll show you in a minute. Given the future of Apple's development in terms of revenue and sales growth and market share opportunities looking ahead, we would say that Apple is perhaps a good buy here, as long as we put a stop in at around 320. Here we see the NASDAQ, which is for Apple its broader market, and we see from here the August 31, beginning of September push higher in the market, and resulting in this very strong run higher for the NASDAQ. Now the NASDAQ sits up here, and by the way, this looks a lot like Apple, doesn't it? Well, it does, because Apple represents now 20% of the NASDAQ. We would be much more comfortable if this NASDAQ would mellow out a little bit and head into more of a lateral to gradual climb versus this very steep climb that we've had. And when the broader market makes that transition from something very steep to more of a lateral or less steep development, the individual stocks within that broader market will perhaps get shaken around a little bit. So we're cautious right now with Apple. So going back to the individual Apple stock, we would be particularly comfortable if Apple would just kind of do a lateral consolidation here and give some of these buyers who have gotten in very early in Apple and before time to reassess whether they want to participate in the stock. Then we could decide whether this would be a good time to get on board. But we've identified from a fundamental standpoint that Apple is not too expensive, and so we are considering an entry at this time. Let's talk about now Steve Jobs' health relative to the stock price. We've seen recently what happened when the announcement was made for his leave of absence, that the stock took a very rapid 9% drop, but recovered rapidly as well. We feel reasonably comfortable with a 320 stop for us and our risk tolerance. And with any investment, we realize that we have to take certain risks. In conclusion, for Apple, we would like to see it build a lateral consolidation here at around $353 a share. That would give the broader market time to transition from this very strong uptrend that we have to more of a lateral consolidation. And then we'd like to see the Apple share price strengthen during that period of time and then get on board for us with a stop at approximately $320 a share. Now let's talk about our tip of the week. How do we handle individual stocks when we're expecting the broader market to transition from such a steep uptrend to more of a lateral consolidation? Individual stocks should be handled very carefully during these transition periods. When the market transitions from a very steep move to a lateral consolidation that's more flat, maybe with a slight uptrend to it, individual stocks will incur a little bit of turbulence. So at this point, we are out of the market as the market has stretched higher in a more unsustainable manner, and we are waiting for this transition to take place before we enter into individual stocks. That concludes our Stock Market Companion video update. We hope that you've learned some things that will assist you in your investing for years to come. You can learn more at our website, stockmarketcompanion.com. There you can also start your free trial. See you next time.